One of Canada's very favorite dividend growth stocks got a huge piece of positive news this week. So today we're going to talk about the bull thesis behind this company, what makes it such an interesting opportunity, and why I own it and am buying more now. To start off, we have an article here from Seeking Alpha talking about a couple of key things. And here is one of the best ways I've ever seen the bull thesis around this written. They could break out to the upside. They have a great dividend with decades of growth. And that's really the story behind Enbridge. It's a dividend growth stock. It has been growing its dividend for as long as anyone can remember, and they are predictably growing their cash flows, which directly translates to their dividend for the foreseeable future. But the biggest risk behind this company was debt. For a long time, people have been saying, hey, they have to take out a bunch of debt in order to create these projects. And just this last week, we saw the US Federal Reserve finally announce the beginning of a rate cut cycle. Not just this tiny little 25 basis point cut. They've announced that they are going to start cutting for the foreseeable future. The dot plot looks great. The future looks, the way they're talking about everything, it looks great. And so all of a sudden, the skies have cleared up a little bit for this stock, and you could see momentum to the upside while still seeing them benefit massively from the increased interest in infrastructure here in Canada and the potential to grow the energy industry. So we're going to cover the bull thesis here, and I think there's so much interesting going on. First and foremost, they're unique and diversified. They're now the largest utility in North America. They're really, really interesting. They have strong results over the last little while. They have a huge backlog that supports their growth. And that's something that people don't fully understand. People look at this and they say, oh man, like look at the payout ratio, for example, right? Payout ratio has been over 100 for a while, and that is concerning. But these guys have a $32 billion capital backlog. They're investing $32 billion, and they can predictably grow their cash flows. So yeah, okay, you might have an excessively high dividend payout ratio, but it's not really all that different from when you see companies or countries borrowing more money than they should be able to because of the growth that will enable in order for them to pay it back and make it a much less strenuous task. So I think there's a huge opportunity there. They have a great starting yield. I mean, we're talking about almost 6%. Who doesn't want a 6% dividend yield? Be honest right now. Anybody who is a dividend investor who could buy that at a safe company, they would do that. They would do that. And that yield just became much more compelling because bonds are going to yield less. You're going to see less in treasuries. You're going to see less everywhere, right? I mean, even interest rates, high yield savings accounts, like anything that is dependent on interest rates is going to be coming down. So the dividend investors, man, like this is one of the greatest times to be a dividend investor. You're going to see all these stocks boom upwards. If you had any profits you wanted to take, right? Look at the next 6-12 months. Look at what happened in 2022. Right? Every dividend stock killed it that year, destroyed the NASDAQ. People were talking about how dividend stocks were like more valuable and better long-term holds than tech and growth that had just dominated the last 10 years. Obviously, that trend didn't last, but if we're looking at that kind of cycle happening again, that could be huge. They've been poised for capital appreciation and higher dividends. They're targeting $50 plus in 2025. That's pretty awesome. Now, the author has some really interesting points in here. I recommend you read the article if that's something you're able to do. Seeking Alpha, right? It's a great service. But there's a couple of key items here. They have made some really awesome strategic growth and organic growth projects, and that has allowed them to become the largest utility in North America. And that is not anything to sneeze at. Like being the largest does give you advantages, flat out. It puts you in a safer position. For example, you have more diversification intrinsically in the business. They operate in all these different markets. If one market sees some sort of catastrophic black swan event, it doesn't take out the company the way that you might see if you have like a localized regional utility. They've also grown into what might be the most complete. They have 30% of the crude produced, 20% of the natural gas consumed in the US, which is big. They have a large scale renewable portfolio and of course the utility. So nobody else is quite that diverse. They're not a one-trick pony. They're not the same business they might have been 10, 15 years ago, right? And while that maybe isn't awesome for some investors, some people loved the business they were 10 years ago, and it was a great business, but this is probably safer. So if you're looking for a dividend and you want to see stability, right? Nobody's investing in dividend growth stocks because they want to see volatility. You want to see stability. You want to buy something you can believe in. You want to see things like those backlogs of projects that have been carefully thought through in order to grow the company at a steady rate, right? All of that is awesome. They do have some awesome growth opportunities ahead of them. you could see like generational wealth if you compound into this company over the amount of time they plan to grow. And I think that's something that some investors don't get, is that the real payout for a dividend growth investor isn't in year 1, 2, 3, 4, 5, or 6, right? It's in year 10, 15, 25, right? In those big long-term investments where you see that kind of compound growth start to become exponential. The author has talked about Enbridge before, not super interesting, but what they do talk about that's super interesting to me is the risks, because this was written in August. And looking at this in September, we see a completely different story, because one of the biggest risks that they talk about is, what if the Fed doesn't cut rates? And you can see where this is going. I mean, we just got news that the Fed is cutting rates. They plan to cut rates for the foreseeable future. And there is generally this massive political pressure on them. I'm not going to say that it's unique to any one Fed governor, and I'm not going to say that they're going to fold, but like as an entity, as a whole, the Trump administration has put a bunch of pressure on these guys to cut rates. So you got to imagine that that's playing in the background. The setting is finally right for them to cut rate. Why would they stop? They're going to be cutting rates. They're going to be cutting rates until you see inflation heat right back up. If that happens, which is a whole different story, but they're going to be cutting rates, which is huge for guys like Enbridge. They're going to be able to build more with the same amount of debt. They're not going to be paying out as much. It's going to make that payout ratio look a lot nicer when they're not paying off so much interest, right? There's all sorts of awesome things. And just, I mean, okay, let's look at this. This is directly from the earnings report, but look at the things they talk about, right? They're seeing a bunch of positives, and I mean, it's an earnings report. They're not going to tell you all the negatives on the top slide, right? They're not going to highlight negative things, but they've got really positive compound growth rates, right? EBITDA is in the high single digits. Earnings per share is in the mid single digits. Distributable cash flows are in the low single digits. All of those are good numbers. Medium term, those EBITDA and DCF and EPS numbers all kind of round out to 5%, which is awesome. A 5% dividend growth rate is great. You're not only beating inflation at a high dividend, but you're going to consistently see growth. And again, if you got long-term holding power, these guys have, again, $32 billion of backlog. That is decades of growth at 5%. And there's a lot of really interesting stuff in here that you can go through. Specific projects that are super interesting. I think if I had to sort of round it out, I would say that you should be looking at a couple different areas. I am obviously quite biased, but I'm really interested in the story around the conventional energy business, as Mark Carney has called it many times, which is really the story around oil and gas. I think that's a great story. I think Enbridge plays a really good role in that story, and I think they're in a great position to maybe benefit from future legislative changes in Canada. Now, I got to be a little bit careful with what I say, because I'm not going to promise you the moon here, but I think there's an opportunity there. Second story, of course, natural gas, power. AI has completely revolutionized the way we use energy. We use so much energy on AI. I saw a metric that said that we use something like 100 times the amount of power for a ChatGPT search that we did for a Google search. And so as you see these AI elements, including Google's own AI, exponentially ramp until just about everyone on Earth is a user, you're going to see that power demand grow. And as you see more and more complicated tasks, all of a sudden we're going to be in this era of increased power demand. Now, a lot of that power demand in the long term could be resolved with things like nuclear, and that's a great option. We're investing in that here in Canada. We're investing in that down in the States, right? Like all across the West, nuclear is kind of being embraced as a longer term solution. But what about the short term? What about the next 5-10 years? Right? It's going to take that long to get sustainable, reliable nuclear power plants built, even if we started last year. So what's going to happen in the meantime? Well, it's going to be natural gas power, and Enbridge plays a great role in that story. So you see them playing into the data center story, the energy production side, the distribution side, right? The natural gas story is the one that I am the most interested in. The better they play in that, the better it looks long-term for them, in my opinion. I think that gives them at least a decade of a really strong position, right? There's likely to be an increase in the overall commodity prices. And while that doesn't necessarily hit them quite as hard as it will for producers, they're going to see some benefit from that as well. And they're continuing. Look at some of the things, right? They talk about capital allocation, right? They talk about that $32 billion secured capital. It's a number I've referenced a couple of times, but look at what they're focused on, right? They're getting their debt to EBITDA down, all while the interest rates are about to come down, right? So refinancing, stuff like that in the future is going to be cheaper than it has been over the last 5 years. They're keeping the DCF up. The dividend is supported by high quality, low risk cash flow. They're a dividend aristocrat, right? They've continually grown that dividend. They've never really threatened it, right? You look at what they're investing in, lots of money going into gas transmission. That's the story I think is interesting. There's some good money going into liquids. I think there's likely to be better money going to liquids, maybe 2029 plus, or, refocused going into that. Obviously, gas distribution is up there. And then renewables. Renewables are getting some investment. I think short term, the renewable story is going to be tough. Flat out, right? The US has definitely taken a harsh stance against renewables. We've seen a lot less emphasis on that in the current climate. We'll have to see what happens there. But really interesting looking at those growth projects, I should say, or projections maybe. Really interesting. And they're going to continue to prioritize investment. They're going to continue to prioritize that growth, which is something that people don't always understand. Some people ask me like, hey, what's Enbridge doing to grow? I'm saying everything, right? They're investing so much money into their growth, and they're huge, right? If you look at the dividend, if you look at the way the dividend has grown, it's beautiful, right? Look at 1995, they're paying, that was probably 20 cents, right? I don't have the number in front of me. That's probably 20 cents. Nowadays, you're paying out $3.50 plus, right? You could be seeing more than that in the future years. It's continued to grow every single year. Obviously, there's been fast times, slow times. I think you're looking at faster times in the future. A lot of people have talked about the advantages that they see. They talked about, basis points of interest rates. They're talking about the targeted profitability. Well, we saw that things did get cut, and there's just so much here. There's so much opportunity. I do want to say there's maybe 2 or 3 things that I think are really, really valuable. First, the concept of oil dying off, of not needing oil in the next 5 years, is basically dead. We're going to see massive changes coming in the next couple of weeks in that story. I've talked about it already on the channel. That benefits Enbridge. Natural gas is becoming more and more in demand. These guys are an absolute juggernaut in that business. They're transmitting a lot of natural gas. They have huge opportunities here in Canada, huge opportunities in the United States. They're going to be a winner from that. Renewables are a long-term growth driver, but short-term are going to see some headwinds. They have already invested a good amount in renewables. They have the flexibility to maybe slow that, grow in the sort of longer term future, but they also have the ability to turn shorter term headwinds into longer term tailwinds, because by sort of slowing down the renewables business, refocusing, they give themselves the opportunity to take advantage of new technologies and better opportunities in the future, because this business is going to be at quite a distressed multiple if the current administration in the States keeps up their current policies. And Enbridge is a known acquirer in this space. So maybe they're going to pick up some assets at sort of distressed valuations. Might be an opportunity for them in that space as well. All in all, I think Enbridge is a fantastic opportunity, and that's why I own a good chunk of it. But I'm not buying it quite as quickly as I might buy, a commodity stock, because the thing about Enbridge is you don't rent it, you own it, right? Commodities, you're going to buy, you're looking at an exit. You're looking at, commodity prices going up, and you're looking at the cyclicality, the cyclical nature of the business. Enbridge isn't like that. Not anymore. Enbridge is not just an oil company, and there are so many people who think it is, that it kind of slides under the radar. And I think that's a shame, to be honest, because it's a great opportunity. It's a great stock, and I think it has a fantastic future ahead of it. So let me know what your thoughts are in the comments down below. Are you buying this? Do you believe in the growth story here, or do you think that it's just a little bit too played out? Do you think the dividend is at risk, or are you happy to buy it and hold it and sit on it for the long term? Let me know your thoughts. If you enjoyed this video, if you enjoy what we do on the channel, please do like it. If you like the kind of topics we cover, you love hearing about Canadian stocks, please do subscribe. And as always, hope I see you in the next one.